Hello my dear friends and welcome to StudyIQ. I am Joy, and today in this lecture we will analyze in depth about the NBFC crisis that is going on. First of all, let us understand what is the current affair. So if we analyze the current affair, we will see that the NBFC sector, that is non-banking financial companies, they are a part of the shadow banking system. So what is meant by shadow banking system? Shadow banking system means the banking activities, that is the lending as well as financial activities conducted by unregulated institutions or under-regulated institutions. That means the regulator or the monetary regulator in the economy is the Reserve Bank of India. So NBFCs are a part of shadow banking system. That means they are under-regulated. They are not regulated in par with the traditional banking system or with the commercial banks. So NBFC is a part of the shadow banking system, and we have discussed about the shadow banking system in the Indian economy in a separate lecture. You can find it on StudyIQ channel or on my Facebook page. So you will get a better understanding of what is shadow banking system, what are the significance, what is the advantage, what are the limitations of such a banking system, etc. Now coming back to our current affair, this shadow banking system in which this NBFCs are also included, this provides services to the public which is similar to the traditional commercial banks, but this is outside the normal banking regulations. We have seen they are under-regulated. But this NBFCs which are a part of the shadow banking system, they are undergoing a turbulent period. So how did this issue in the NBFC sector started? It started with a series of defaults by the ILNFS company. So this default episode of ILNFS, which is an NBFC, and the subsequent liquidity crunch has led to a turbulent period for the NBFC sector. So we will see what it is. And because of this liquidity squeeze that is faced by the NBFCs, it has led to a conflict between the government as well as the RBI. Government is the fiscal head, RBI is the monetary head. So there is a clash or conflict going on between these two. What is the government trying for? Government is trying for easier fund flows. And what is RBI trying for? RBI is insisting that there is enough money available in the system. Therefore, there is no need to further expand the liquidity in the market. So this is the conflict of interest of RBI as well as the government, and on the background of this NBFC crisis, we will analyze this issue in this lecture. Let us start. Let us see what is the crisis in the NBFC sector and how it started. We have already said that this liquidity squeeze in the NBFC sector started with a series of defaults made by the ILNFS company, and which led to a further liquidity crunch in the NBFC sector. So we will analyze it. There were several corporates, mutual funds and insurance companies that had invested in the short-term instruments of the ILNFS group. So this short-term investments were made by the corporates, mutual funds, insurance companies, etc. And the instruments were like commercial papers, non-convertible debentures, etc. So they had invested for short term in the ILNFS company. But what happened later on, from the month of August onwards, this ILNFS company started making default payments, and this default payments led to a liquidity crunch. And how did this liquidity crunch happen due to this default payments? Because there was a fear in the market that the funding cost for the NBFCs will increase, and as a result of that, it will lead to a sharp decline in the profit of the NBFCs. So because of this, the liquidity crunch happened in the NBFC sector. Now we will see what was the role of the banks in further expanding this problem. So there was a liquidity crunch due to this default payments. So it started with default payments by the ILNFS. Now what did the banks do? Because of this liquidity crunch, banks slow down lending to NBFCs. So because in the NBFC sector there is a liquidity crunch, so banks limited or slowed down lending to NBFCs. And because of this slowdown in the lending by the banks, a major resource avenue for the NBFCs and HFCs came closed. So it was from the banks that the NBFCs and the housing finance companies, HFCs, borrowed money. And because of this liquidity crunch, banks were reluctant to lend money to NBFCs. And because of this, NBFCs were negatively impacted. There were two reasons. One, already there was a scenario of high interest rates. And because of the liquidity crunch, the sourcing of the funds also became tough. So it was difficult for the NBFCs to get the funds. And further, adding to this problem, the defaults had kept the potential investors away from the investment in NBFCs. Because of all these issues, the fund availability for the NBFCs became very tight. And due to all these problems, what happened in the stock market, there was a sharp loss in the NBFC stocks. So this became a vicious cycle. Unavailability of funds, no investments, further sharp loss in the NBFC stocks. Now let us understand what is the fundamental issue. How this started. We have seen it happened because of the defaults made by the IL&FS. So we will see how this defaults in the IL&FS happened. So the fundamental issue here is the asset liability mismatch. So there was an asset liability mismatch in the operations of the NBFCs like the IL&FS. We will see how this mismatch happened. Usually the NBFCs like the IL&FS, they borrow from the market for shorter periods of time. Say for example 3 to 5 years of time. So their borrowings are for 3 to 5 years, but their lending is for very longer tenures. Say for example 10 years. IL&FS is an infrastructure investment company, and therefore obviously their investment would be for 10 years. So lending for 10 years and borrowing for 3 to 5 years. Now, how does this asset liability mismatch happens? Suppose, for example, in the year 2005, the IL&FS had borrowed from a company or a corporate for shorter period, that is for 3 to 5 years, and suppose the interest rate is 10%. Now, in the same year, that is in 2005, IL&FS will lend some money to an investment company or infrastructure company. So, this will be for 12% interest, let us assume. But what happens here? This borrowing is for shorter periods, but lending is for longer periods. So for the longer period lending, what happens? After 3 or 4 or 5 years, the interest rates will increase. So there is an interest rate mismatch between the borrowing and the lending. So this will lead to loss for the company. So one primary reason is the interest rate mismatch for the company. And secondly, for a company like IL&FS, which is involved in infrastructure investment, stalled projects also affect their performance. For example, construction of a road. There are a series of steps involved in construction of a road. There are issues of permits, land acquisition, and all this can get delayed. And whenever a procedure gets delayed, what happens? The project also gets extended. So for a company like IL&FS, which primarily makes investment in infrastructure, when there are increasing number of stalled projects, their profitability is also affected in a negative manner. So these two are the primary reasons or fundamental reasons that led to the loss of IL&FS company. And because of the loss incurred by the IL&FS, they started making payment defaults, and this payment defaults led to liquidity crunch in the NBFC market. So the cycle is like this. Because of this fundamental issue, that is asset liability mismatch, defaults happened, and because of defaults there was a liquidity crunch in the NBFC market, and because of this liquidity crunch, fund availability became very difficult for the NBFCs, and this led to a liquidity crisis in the NBFC sector. Now let us understand what is the role of Reserve Bank of India in this. What did RBI do in order to help the NBFCs overcome this situation? So the Reserve Bank of India purchased government securities through the open market operations. So what is open market operations? Under open market operations, the purchase or sale of government securities take place in order to increase or decrease the liquidity in the market. So when the government securities are purchased from the general public, what will happen? The liquidity increases. And when government securities are sold, what happens? It is sold to the general public, so liquidity from the public is absorbed. So what did RBI do here? It purchased government securities. That means from the market it purchased government securities, and instead liquidity was released to the market. So we will see that RBI had injected money into the market through open market operations, and it was for an amount of 40,000 crore. This was on top of 36,000 crore injected through open market operations in early October, and the second phase of open market operations were done during the last week of October. In the first week already it had injected 36,000 crore rupees into the market through the open market operations. Now let us consider special window. The government as well as the industry had pushed the RBI in order to open a special window to meet the fund requirements of the NBFC sector. But RBI rejected to open the special window. RBI rejected on the ground that it has already provided many options through OMOs, and if the special window is open to ILNFS, any other NBFC or any other company which will approach the RBI with the same request, RBI will have to provide that also. So RBI rejected an option of special window for ILNFS. And the SBI, State Bank of India, also had certain role. On 10th of October, the SBI offered to bail out NBFCs with a proposal to buy good quality assets of 45,000 crore from them. Now let us analyze the past involvement of the Reserve Bank of India in the NBFC sector. So let us take 2008-9. It was the period after the global financial crisis. So in 2008-9, after the global financial crisis, the Reserve Bank of India offered a special repo window for banks, and through the special repo window, the banks will be able to lend further to the NBFCs. This was not only for NBFCs but also for mutual funds and also HFCs, that is housing finance companies. So this was after the global financial crisis. Now again in the year 2013, RBI had stepped in. RBI opened a 3-day special liquidity window of rupees 25,000 crore for the banks to meet the cash requirements of debt mutual funds. During that period, the mutual fund industry was facing a redemption pressure after the bond prices fell, leading to lower net value assets. So, in 2013 and 2008-9, we will see RBI had opened a special window. But now, in 2018 NBFC crisis, RBI rejected the demand of the government to open a special window for the NBFC sector, and we will later see how this has led to a conflict between the government and the RBI. Now let us understand the status or significance of NBFC industry in India. First, let us compare it with banks. So, in a period when the banks had slowed down their lending business in the wake of huge bad loans, we have seen that both in private sector as well as in public sector banks, there is an issue of NPA or mounting non-performing assets. So, in this period, NBFCs have continued to grow at a higher pace. So, the significance or importance of NBFCs in Indian market increased with this mounting NPAs in the banks, and because of this mounting NPAs, banks were not able to provide so much of credit that the market required. Now, if we look at the numbers, there are 11,402 NBFCs which are registered with the RBI. There are lot more NBFCs which are not registered with the RBI, but with those registered with the RBI, it is 11,402 as on March 2018. And if we analyze the aggregate balance sheet of the NBFC industry, the aggregate balance sheet size of the NBFC sector as of March 2018 was rupees 22.1 lakh crore. And we will see there is a deceleration in the capital growth, but the borrowings of this industry increased to 19.1%. So borrowings rate growth is 19.1%. And we will also see there is a wider group of NBFCs in Indian markets. It is not just finance companies, but also there are various NBFCs, non-banking financial companies, which are engaged in investment business, insurance, chit funds, nidhi, merchant banking, stock broking, alternate investments, etc. So there are a wider group of NBFCs in the Indian market, and their role is also very wide. They play a role of financial intermediaries, and because of this role, they are playing a supplementary role to the banks. Wherever banks underperform or banks are not able to meet the demand of the market, NBFCs step in. And regarding the financial inclusion, NBFCs, especially those catering to the urban and the rural poor, which includes MFIs, microfinance institutions, or AFCs, that is asset finance companies, they have a complementary role in financial inclusion agenda of the country. So they have a significant role in improving the financial inclusion of the country. Now if we consider the growth and development of the economy, some big NBFCs, for example infrastructure finance companies like the ILNFS, who lend exclusively for infrastructural sector, they play a major role in the growth and development of the country. And also considering all this importance of NBFCs, they bring in diversity to the financial sector. And what is the fund source of NBFCs? And their gross receivables is only 31,200 crore, and the instruments are long-term debt, loans, commercial papers, etc. Now let us consider what are the concerns in the NBFC sector at present. First one is regarding the funding of the NBFCs. Because of the liquidity crunch, they are facing a problem of funding in the NBFC sector. This is because of the reversal in liquidity. We have seen how this has happened. Now second one is increased or higher borrowing cost. One, because of increased interest rates. Secondly, because of lack of investments. Thirdly, because of unavailability of funds. Because of all this, the cost of borrowings in the NBFC sector has increased. And third concern is that of RBI, the Reserve Bank of India. And Reserve Bank of India is likely to tighten the guidelines for NBFCs and HFCs. So, tightening the norms means they will again face a problem. And the intention of the RBI is to bring the NBFCs almost on par with commercial banks in terms of regulation. We have seen that NBFCs are included in the shadow banking. They are under-regulated. So, in order to bring them on par with the commercial banks in the economy, RBI is intending to tighten the norms for the NBFCs. And this tightening policy of the RBI is evident from 2018. That is, after the global financial crisis, we have seen RBI is trying to tighten the norms for NBFCs. So, if we observe, the minimum Tier 1 capital was increased to 10% from 7% in a phased manner by the end of March 2017. And also the asset classification norms was revised from 180 days to 90 days in a phased manner by March 2018. So these are the concerns faced by the NBFC sector now. And because of this difference of opinion between the RBI and the government, it has led to a conflict, and we will discuss about it in detail. We will also discuss about the section 7 of the RBI Act in a different lecture. You can find it in StudyIQ channel or on my Facebook page. Thank you, and I wish you all a very good day.